This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Slow start. The economy is limping along at its slowest pace of growth in 3 years. So why aren't economists worried?
At a crossroads, ExxonMobil and Chevron report solid quarters, but not everything is turning around for big oil.
At odds, lawmakers avert a government shutdown for now, but another budget battle may just be starting. Those stories and more tonight on Nightly Business Report for Friday, April 28th.
Good evening, everyone, and welcome. Well, getting the economy growing again faster is a goal of the Trump administration and a desire of investors and, of course, American workers. But today, a new report shows it's certainly not happening just yet. According to the Commerce Department, the economy stumbled in the first quarter. Gross domestic product, which is basically the broadest measure of U.S. output, grew at a paltry rate of 0.7% and below even what had been expected. Even an increase in confidence readings over the past few months didn't translate into strong consumer spending, which accounts for roughly 70% of economic activity. So while the headlines are disappointing, upon closer inspection, the anemic reading may not be all that bad. Steve Leisman did some digging.
Weak growth in first quarter GDP doesn't have economists worried that the economy is really weak. Instead, they see a bunch of one-off factors pushing down the growth rate to just 0.7%. Most believe a bounce back in the current quarter is likely. A big part of the weakness came from inventory adjustments, but forecasters think that bounces back as companies restock their shelves in the current quarter. Consumer spending was also slow, which contradicts both buoyant confidence measures and fairly strong job growth. Another quirk? Q1 growth has been unusually weak for years, a problem that economists say is because of the data crunching, not the actual economy.
Q1 has been very weak. We thought, actually, our guess is that the government might fix it because some of the seasonality is in defense. You'd think they would be able to adjust for that.
So many forecasters believe growth in the current quarter is likely to clock in at around 3%, with some even boosting their forecast today. But when you average it out, it's still around 2%. And the bigger question is whether the economy can do better.
I have to think this will give the administration, the Congress, more impetus to make some good policy to get that growth rate closer to 3%.
But the effects of those changes to tax and spending policies are months, if not years in the distance, if the advertised growth happens at all. For now, the best that can be hoped for is that weak first quarter growth was really an anomaly, and that the economy is bouncing back right now as we speak. For Nightly Business Report, I'm Steve Leisman in Washington.
While economic growth is sluggish, earnings are rebounding. ExxonMobil and Chevron, the two latest examples. Exxon saw its earnings double, while Chevron swung to a profit. Both were helped by cost cuts and a rise in the price of oil. That helped send shares of the Dow components higher in trading today. But as Bob Pisani explains, there are still some headwinds for the industry.
You could say big oil earnings are at a crossroads right now. The markets are near historic highs and earnings are rebounding nicely. But the one fly in the ointment is the energy stocks. They're down more than 10% this year. This while the S&P is up 7%. That's a huge disparity. It wasn't supposed to be this way. This was supposed to be the year of the big turnaround for big oil. But so far that has not been the case. Crude oil is down 9% year to date. The global energy market is undergoing a massive transition, shifting the focus away from the Middle East and toward the U.S. It's a huge help to consumers, and it's a big headache for big oil. The result is the investor love affair with energy is waning. Oil stocks don't just lose on a fundamental level, they lose as a relative value play. Why buy oil stocks with oil down and the rest of the market is up? You take ExxonMobil. They reported earnings this morning. The good news is they beat earnings expectations, and overall, earnings more than double compared to the first quarter of last year. That's largely because oil prices improved from about $30 a barrel average in the first quarter last year to $50 in the first quarter this year. That's good news. The bad news is the price of oil is trending down recently, and they're producing less of it, at least Exxon is. The magic combination of an improving economy plus OPEC production cuts was supposed to drive oil to $60 and maybe beyond. Well, what messed this whole thing up, of course, was shale production. Even if OPEC continues to cut, how can oil move up when you have this enormous open faucet that is North American shale? The big hope is that eventually oil prices will rise again, fueled by an improving global economy, continued OPEC cuts, and less capital spending by the big oil companies. Well, we'll see. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
On Wall Street, stocks sagged as earnings reports and new data on the economy were not enough to lift the market today. And investors will be keenly watching developments this weekend after reports that North Korea unsuccessfully tested yet again a ballistic missile late this afternoon. On this last trading day of the month of April, the Dow Jones Industrial Average was off 40 points to 20,940. NASDAQ lost 1, and the S&P 500 fell 4.5. For April, all of the major indexes were higher, as you see there, with the biggest gain coming from the record-setting NASDAQ.
The gains since President Trump took office are even bigger. As he gets ready to mark his 100th day in office in the White House, the major indexes are all up 5% or more. As we've been reporting, the market has rallied in recent months, in large part because of expectations that the Trump administration will push through pro-growth policies. The 3 pillars of his economic agenda include tax reform for both individuals and corporations, infrastructure spending, and deregulating industry. But at the 100-day mark, some on Wall Street say frustration is beginning to set in because these reforms haven't happened as quickly as hoped. And that may be a reason why the rally has recently lost some momentum. Dominic Chu has more.
The stock market has generated some stellar returns since the election last November, but the trajectory of those gains has moderated over the last couple of months. The index gained around 12% between the election day close and the record highs on March 1st. But since then, markets have been trading in a relatively narrow range and have pretty much gone nowhere.
I think the market is waiting to see first quarter earnings, and particularly to see that the growth is sustainable from the economy, and also looking for any sectors, any industries in the economy that look as if they may be growing faster.
Financial markets are often referred to as discounting mechanisms. That is to say, they take all available current information and future expectations and then puts a price on it today. Many experts believe that the coming weeks will be all about whether President Trump's administration can have the ability to make progress on things like tax and healthcare reform and whatever else it takes to revive economic growth.
Investors are going to be most keen on what kind of policy comes forward, particularly as it relates to corporate tax reform. So getting back on track with regard to moving that legislation forward will, I think, be key to making a difference between what might be good returns for the equity markets and potentially great.
Stocks are entering the summer season, one which many say is a seasonally weaker time of the year, so there could be headwinds to returns in the coming months. But there's still optimism medium to longer term.
The gains are still there relative to where we were from November, and we expect again that trade to resume once we start to get more tangible evidence that in fact legislation will be converted to actual law.
The market is looking for the next catalyst, whether it's President Trump or corporate profits or geopolitical concerns, and whether that catalyst keeps the rally going higher or sends markets lower. For Nightly Business Report, I'm Dominic Chu.
Let's turn now to Jimmy Lee for more perspective on the market and what might lie ahead in the days and weeks to come. He's CEO of the Wealth Consulting Group. Mr. Lee, welcome. Good to have you with us. Let me begin with the late news this afternoon that the North Koreans once again attempted to test a ballistic missile. It apparently failed or did not succeed in the ways that the regime might have liked. Are you worried that the biggest risk to momentum in the market may come from some outside geopolitical risk or something else?
It's a big concern, Tyler, and you know, in the short term especially, if something happens between North Korea and the U.S., I think it could cause a lot of panic and potential concern amongst investors, and definitely could cause a lot of volatility. So we're watching it closely. I'm South Korean, and so it's something that's particular of interest to me. I have some family members in South Korea too, but it is definitely a concern. I
can understand that, certainly. Are you doing anything different with your clients' money, either in anticipation of the things heating up in that part of the world, or are you simply watching it closely?
Watching it very closely, but Sue, if we do get some sort of a correction because of these geopolitical concerns, whether it's North Korea or maybe the election in France, I really think it's a buying opportunity for investors in the long term. And so I think there's a lot of dry powder that has been waiting for a correction. On the other hand, I think one of the biggest risks out there is that people don't buy on the corrections, or they're waiting for something really deep to happen, a severe bear market, which I just don't think is going to happen.
Let's talk about the topic that we sort of began the broadcast with, and that is some soggy economic numbers, 0.7% growth in the first quarter, and yet the stock market is moving up rather briskly. What's the disconnect? Should we be worried about that? Is the first quarter just an anomalous print on the GDP?
I think it is, actually. And you've got to remember that analysts were predicting, I think, a 0.9. So it wasn't that far off from the actual predictions. And I think that it will actually pick up. We had consumer spending peak in the fourth quarter last year. So have a little bit of a setback in the first quarter is not that bad, I don't think. But I think in the second quarter and possibly beyond, you know, a lot of this rise in the equity prices since the Trump election has to do as much with, you know, an idea of a cap on taxes and no more regulation as it does with maybe, you know, how good the actual reforms might be.
Mm-hmm. Very quickly, in the time we have left, Jimmy, what areas of the market do you think still have some room to run?
Well, we always favor a globally diversified portfolio, but we've over-allocated a little bit into emerging markets. We also think that the technology sectors and the industrial sectors are good. And when interest rates start to finally rise, financials will also rise with it, we believe.
All right, Jimmy, thanks very much. Jimmy Lee joining us tonight from Las Vegas. He's with the Wealth Consulting Group.
Still ahead, lawmakers pass a funding bill to keep the government up and running. But the fight over spending may be only intensifying.
United Continental CEO Oscar Munoz will testify before a congressional panel next week. On Tuesday, lawmakers will ask him about the forced removal of a passenger from a flight earlier this month. The hearing's goal is to determine what can be done to improve flying for American travelers.
Also in Washington, President Trump signed an executive order aimed at expanding drilling in the Arctic. The order starts to reverse some of former President Barack Obama's actions and directs the Interior Secretary to review locations for exploration that had been considered off-limits.
This executive order starts the process of opening offshore areas to job-creating energy exploration. It reverses the previous administration's Arctic leasing ban.
The order has the potential to open oil exploration in areas off Virginia, North and South Carolina, where drilling is currently blocked.
On Capitol Hill, lawmakers voted to pass a short-term spending bill that averts a government shutdown at least for another week. But the battle over the budget is far from over. Kayla Tausche has our report.
The ayes appear to have it. The ayes do have it. The bill is passed.
With that, the Senate passed the funding needed to keep the government operating for a week. The challenge now, reaching a longer-term deal that funds the government through September, when its fiscal year ends. Democrats have signaled there's more work to be done before they'll support that.
I want to put my colleagues on notice and the American people on notice, Mr. Speaker, that I will not vote for another one.
We're willing to extend things for a little bit more time in hopes that the same kind of progress can continue to be made. But we still have a little bit of a ways to go.
The president's budget calls for sharp increases in military spending and steep cuts to environmental and diplomatic programs. The White House offered two olive branches, withdrawing a request to fund a controversial wall along the border with Mexico and continuing to make payments, for now, to insurance providers for offering plans to low-income customers under the Affordable Care Act. But it's some smaller, extraneous provisions, emergency funds for Puerto Rico, for example, that have the two sides at odds.
It's going to get done now, and there'll be some significant victories for the president, but there'll also be a lot of bipartisan compromise in it. That's the way appropriations work.
House and Senate staffers are set to work through the weekend to try and finalize a deal. To meet their own rules, an agreement should be voted on by Tuesday before the short-term measure is set to run out on Friday. For Nightly Business Report, I'm Kayla Tausche, Washington.
Time Inc. takes down the for sale sign, and that's where we begin tonight's market focus. After evaluating interest from potential buyers, Time said that it will stay an independent company and continue to pursue its strategic plan. The publisher of Sports Illustrated and Fortune, among other things, said it will focus on its digital business and initiate cost-cutting measures. Time Inc. made headlines earlier this year after there were rumors the company was seeking buyout offers. Shares today plunged almost 17% to $15.20. Strong demand in the U.S. for pickup trucks and SUVs helped General Motors post a profit that grew and topped estimates. The company acknowledged currency headwinds negatively impacted results in some of its foreign markets, but overall, sales still rose more than expected. GM shares rose as well, fractionally to $34.64. VF Corp reported a bigger than expected drop in revenue, even as the apparel company saw sales strength in its international business and also its outdoor and action sports division, which carries the North Face brand. The company's earnings were in line with estimates. VF Corp shares fell more than 5.5% to $54.63. And a rise in sales helped Royal Caribbean top earnings expectations. The cruise operator raised its outlook for the year and also launched a $500 million share buyback program. The company said its business is doing well globally.
The U.S. market is doing well. The Canadian market is doing well. Europe is going very nicely. China has been a terrific success for us. In fact, throughout Asia, we're seeing Australia and all of Asia is just going very well. So there really is, in fact, I can't remember a time when so many markets all seem to be lining up in a positive way.
Well, shares popped 6% to $106.60.
Colgate saw a profit rise and beat estimates, but the company's revenue didn't perform as well. The consumer products company reported flat sales as weakness in North America hurt results. Colgate also said it sees net sales for the year rising in the low single digits. Shares off more than 1% at $72.04. Goodyear faced higher material costs and weaker demand, but still managed to beat profit forecasts. The company said a drop in tire shipments, though, contributed to its weaker than expected revenue. Shares still rose more than 2% to $36.23. And the enterprise software firm Cloudera saw its shares pop in their first day of trading on the New York Stock Exchange, a clear day for Cloudera. Shares of the company's initial public offering were priced at $15 a share. That was the high end of the anticipated range. CEO Tom Riley said going public was the right move.
With the proceeds from the IPO, that gives us even greater flexibility to look long term, look at this big market, and make sure that we remain the market leader by making the right investments, having the right partnerships.
Shares soared more than 20% on the day to $18.10. Good for them.
Our market monitor joins us, is bargain hunting for some names that he says are overlooked by the rest of the market. Last time he was on, over a year ago, he recommended Apple, which is up 49%. Bank of America is up 91%. Ford, a little bit of a hit, down about 6%. Joining us now is Chris Cordero, Chief Investment Officer at Regent Atlantic. Good to have you back.
Well, it's good to be here.
Welcome. So you think that these are overlooked stocks in a market that has been rising quite nicely for many stocks.
The market's been rising, but I think these are some hidden values that people aren't really paying attention to. The tech stocks are taking a lot of the big names, but these are ones that I think will have some resiliency going forward.
Total is one of the picks that you have for us tonight, the big oil company.
The big French oil company. I really like Total because they're a great buy right now. So they're selling at a real bargain. But the best thing I like about them is they're of all the major oil companies, they are the most environmentally friendly by far. And I think in the long run, this is going to put them in a much better position. So short run, they're a great bargain. Long run, they realize they might be in the buggy whip business, and cars are coming around.
Energy stocks have not performed all that well so far this year, as Bob Pisani reported earlier. This is a long-term play.
Yes, this is a long-term play, and that's also looking at in the environmental aspect of them as well.
And only a 91% gain in Bank of America. What are you doing wrong here? I mean, come on, man.
Thanks for not harping on the Ford.
Yeah. Let's turn to Comcast, which of course is the parent company of CNBC, which produces this broadcast. You like it for a variety of reasons.
I like it, and what I really like it for is for the pipes. So Comcast delivers the broadband for over a quarter of the country. And so with that, that's where they're going to make their money. That's where they're positioned it. You know, my kids, they don't watch TV. They look on their computer. They watch content on their computer.
Nightly business
of maybe tonight.
And finally, we finish up with Oracle. It's kind of old guard tech, but you think that there are some unusual things that this company is doing to execute.
Exactly, and this is the one where I think it's getting overlooked because Oracle really does have a very strong cloud presence, and they're building it more and more. So you have that backbone infrastructure from Oracle combined with what they're doing on the cloud. I think this is one that the market is missing, and I think if you're looking to play the cloud, this is one of the best bets to do.
Who's getting it right? The economy growing just 0.7% or the market growing 5, 6, 7% so far this year?
Well, so the market looks out the windshield. The GDP number is looking in the rearview mirror. Looking out the windshield, what's going on is we have disposable earnings going up 4%. We have consumer confidence hitting 16-year highs. That's going to translate into much better growth later on in the year.
All right. On that note, Chris, thank you so much for coming in tonight. We appreciate it.
Oh, great to be here.
Chris
Thanks
Cordero
for being with us.
With Regent Atlantic.
And coming up, dollars and cents, a football pro turned financial pro, and his advice to avoid fumbling a financial windfall for some of those draftees.
Here's a look at what to watch for next week. On Tuesday, Apple, the world's most valuable publicly traded company, reports its earnings. On Wednesday, Federal Reserve policymakers make a decision on interest rates at its two-day meeting wraps up. And on Friday, the monthly employment report for April is released, and that's what to watch for next week.
Here's a little known fact about Amazon, the company which has a $5 billion share repurchase program in place, did not buy back any of its shares in the first quarter. In fact, according to a filing with the SEC, Amazon hasn't bought back any stock since 2012, when it repurchased more than 5 million shares at an average price of roughly $180 apiece. The stock today closed around $925 a share, indicating that maybe the company hasn't needed to buy back its stock. That's a record on the back of its earnings that we told you about last night.
It is day 2 of the 2017 NFL Draft, and the National Football League is making some dreams come true for some young top athletes from around the country, giving them multi-million-dollar deals to play football for the teams that they love. But if you've never had this much money before, how do you manage your sudden windfall? Charles Way, former pro football player himself and now managing director at Purple Bridge Management, has some financial advice. It's good to see you. Welcome.
It's great to be here.
It is a very exciting time for these young men. You know, they've been dreaming about playing pro football, and here they are. But it must be a little daunting and maybe even frightening for them when they get these multi-million-dollar contracts in some cases.
It is. You have to think about it. You worked all your life for this very moment, and now you're going to be thrust with tons of responsibility, not only on the football field, but off the football field as well. And it could be quite complicating.
A lot of these guys, some of them aren't even college seniors who are getting drafted. They're underclassmen as well. I suspect are very unprepared for the financial responsibilities they're going to have. Do the teams, does the NFL give them any assistance to teach them how to manage money responsibly? Do they screen any of the agents or financial advisors who these guys might be approached by?
Yes, definitely. It started way back in the early 90s when teams started to think about, are these guys actually prepared to handle this money when they leave? And so it kind of evolved over the course of the years. And recently, now the clubs are taking more responsibility of educating their players when they come in. And the great thing about the evolution of this financial literacy program is that some teams are taking it even one step further and educating their families as well.
Yep, I was going to say that's a key component, because in some cases, they will be supporting the entire family. What do you counsel them? What's the best piece of advice that you give them when you talk to an athlete?
You know, when you first get into the league, it's really about establishing yourself as a player. And so you don't need to be worrying about your finances. So really what we tell them is preserve your wealth. You don't need to get into anything fancy. And first of all, you don't understand, most of the players coming in don't understand the intricacies of finance. So we tell them, look, focus on football, put your money in a safe place. And once you make it after year 3, year 4, then you've become established, and then you can start thinking about some sophisticated ways to manage, to invest your money.
Is the biggest risk to these young guys that they spend it too quickly? Because let's be frank here, the average NFL career is what, 4 years?
Yeah, it's between 3 and 5 years, and that is the concern. But you got to understand, think about it. Is any college graduate ready for the real world? Right. And so we're just adding a few zeros to make things complicated. So I think it's important for us to understand that and work with them as they grow and go through the process.
Are they willing to let you do that? Do they take the advice?
Most players do, and I think it's because of the approach the NFL and the National Football League Players Association have, is that we want to engage them and we want to continually tell them that this is for your life after football. We want to establish a great foundation so you don't have to worry about
if they get hurt or if they can't play.
And you can take your time in finding that next career.
Charles, thank you so much.
You're welcome.
Charles Way.
Fellow UVA guy.
That's right.
That's right. Purple Bridge Management. That does it for us on Nightly Business Report. I'm Sue Herrera. Thanks for joining us.
I'm Tyler Mathisen. Thanks from me as well. Have a great weekend, everybody. We'll see you Monday.